Welcome back to the channel. Today we're doing a gold price forecast for January 29, 2026. We'll look at both global markets and the US gold market. This forecast is based on the latest market data and expert views. Please note this isn't financial advice, it's market discussion backed by current information. First, let's recap the current gold price situation. As of January 29th, gold prices have been rising sharply. Spot gold has climbed to around $5,500 per ounce in global trading. In some sessions, prices nearly hit $5,600 an ounce. This is a historic level of price strength. Gold demand remains very strong. Investors worldwide are buying gold as a safe haven. Geopolitical tensions are a major factor. Conflicts and uncertainty push money into gold. Gold is traditionally a store of value in uncertain times. Recent monthly gains have been significant. This has caused market forecasts to shift rapidly. Before we look at tomorrow's forecast, let's consider the drivers. One key driver is the US dollar. A weaker dollar generally supports higher gold prices. Right now, the dollar is relatively weak. That makes gold more attractive to international investors. Another key influence is Federal Reserve policy. The Fed's recent decision was to hold interest rates steady. Investors were watching the Fed closely, but the decision lacked clear guidance on future cuts. That uncertainty favors gold. Lower interest expectations reduce the opportunity cost of holding gold. Gold doesn't pay interest, so lower rates help gold's appeal. Another driver is institutional demand. Central banks around the world are buying gold. This increases long-term demand. Major funds and ETFs are also accumulating. Spikes in ETF inflows show confidence in gold's role. Commodities traders see gold as safer than stocks. That's part of why prices have continued to rise. Now let's talk about what forecasters and analysts are saying. Many global institutions expected gold to trade high in 2026. Some forecasts previously saw targets around $5,000 an ounce for the year. But actual prices have already moved above those levels. That shows how quickly markets can shift. Some aggressive forecasts have suggested even higher targets. For example, some analysts see gold rising towards $6,000 within 2026 under certain conditions. These forecasts depend on macroeconomic factors aligning. Let's break down what could push gold further. First, geopolitical risk could increase. Higher risk generally equals more safe haven buying. Second, the dollar could weaken more. A weaker dollar boosts gold demand. Third, global inflation expectations could rise again. Higher inflation can support gold as an inflation hedge. Fourth, interest rate expectations might shift lower. If the Fed signals rate cuts, gold could jump. Conversely, higher than expected rates could slow gold. So, what do data suggest for January 29th? Existing price data shows continued momentum. Sharp increases earlier this week carried into today. This could point to further upside tomorrow. But markets do not move in straight lines. Corrections can and do occur. The rapid rise means some traders may take profits. Profit-taking can lead to short-term pullbacks. Still, fundamentals show continued buying interest. Now, let's forecast global gold price direction for tomorrow. Base case: prices stay elevated or move slightly higher. This is supported by strong demand and risk factors. If geopolitical tension persists, gold may continue rising. Gold could approach or exceed recent highs near $5,600. That's assuming risk sentiment remains strong. However, a pullback is also possible, especially if dollar strength returns, or if a major economic indicator surprises markets. Such surprises can shift capital flows quickly. Let's talk about the US specifically. The US gold market generally follows global trends, but it also reacts to US economic data. Strong US economic growth could temper safe haven demand. Conversely, weak data favors gold. Tomorrow's forecast must consider US jobs, inflation, or PMI data. If data shows weakening, gold could rally further. If data is stronger than expected, gold might pull back. The Fed's communication will be crucial. Markets react quickly to Fed tone. Hawkish signals could pause gold's run. Dovish signals could accelerate it. Analysts remain cautious but bullish on the medium term. Let's present a more detailed forecast for U.S. gold prices. Scenario: continued upside momentum. In this scenario, gold trades near current highs. Prices could stay around $5,500, $5,600. Some traders may push prices slightly above those levels. Scenario B: pullback then continuation. Prices may retreat modestly before resuming uptrend. This could occur if traders take profits, or if short-term dollar strength emerges. Scenario C: breakout continuation. If risk factors worsen, gold could break above recent highs. There is psychological momentum above $5,500. Traders watching this level see it as significant resistance. If broken, it becomes support. Technical traders often react strongly to these shifts. But it's not just technicals, fundamentals matter. Strong institutional demand remains a key driver. Central bank purchases are persistent. ETF accumulation signals ongoing interest. Retail investor sentiment also supports cautious optimism. However, retail sentiment can swing quickly. Gold's rapid rise has surprised many. Predictive models may revise forecasts frequently. For short-term forecasts like tomorrow, trend consistency is key. Candlestick momentum and volume patterns can indicate direction. Broadly, the trend has been upward, but volatility is elevated. Volatility itself creates opportunities and risks. Let's summarize tomorrow's expected price movement. The most likely scenario is continued high levels. Prices may edge up further if markets remain risk-off. Another possibility is sideways consolidation. Consolidation often follows big moves. These pauses can prep for the next leg. Pullbacks can be shallow or deeper. It depends on macroeconomic releases. Now let's address what experts have publicly said. Some institutions previously targeted gold around $5,000 in 2026. Others suggest even higher targets under certain conditions. But forecasts differ depending on models and assumptions. A variety of analytical tools are used. Some use fundamentals, others include technical data. Some combine both with machine learning models. But no model can predict perfectly. Market conditions can change rapidly, so forecasts are always conditional. That's why a range of outcomes is more realistic than a single number. Even for a one-day forecast like tomorrow, market players should watch macro data, they should watch geopolitical headlines, and they should watch central bank moves. We should also watch sentiment indicators. Sentiment often signals shifts before price moves. High fear can fuel gold rallies. High confidence can slow price increases. For example, if U.S. stock markets rally strongly, safe havens may weaken. But if stocks falter, gold shines. Let's also consider inflation expectations. If inflation remains stubbornly high, gold demand can stay strong. Inflation hedging remains a key use case for gold. Interest rate expectations will move gold prices. Lower expected rates support gold. Higher expected rates may slow it. Another factor is bond yields. Lower real yields favor gold. Higher real yields can challenge gold, so macro context matters greatly for forecast accuracy. Now let's articulate our final forecast for January 29th. Base case: gold stays elevated and may rise modestly. This is likely if risk factors persist. Bullish case: break above recent highs near $5,600, possibly approaching new record levels. Neutral case: sideways consolidation near current levels. Bearish case: short-term pullback if a strong macro surprise emerges. But even in a pullback, gold may still close above previous levels. Let's also consider what this means for U.S. investors. U.S. dollar moves matter for U.S. traders. Equity markets can influence gold strategies. Strong bond markets may counter gold gains. But with inflation concerns and rate uncertainty, gold remains relevant. Gold's role as a hedge is prominent in U.S. portfolios. Most institutional investors see gold as risk insurance. Retail investors also watch gold closely. Volatility in other assets may push capital into gold, but risk assets outperforming might draw money away, so balance matters in forecasting. At the end of the day, tomorrow's price will be determined by the interaction of many factors. It may surprise some market participants. That's the nature of markets. Now let's talk about risk management. For traders, set stop losses. For investors, think long-term. Avoid emotional decisions based on headlines. Headline moves can exaggerate risk perceptions. Instead, focus on macro context over time. Long-term holders should consider strategic allocation. Short-term traders should watch volatility indicators. In any forecast, risk and reward are linked. Now let's wrap up with a concise forecast summary. Global market forecast for January 29th, continued strength or modest gains. U.S. market forecast for January 29th, similar direction influenced by macro data. Most probable movement, high levels with possible volatility. Key levels watch. Recent highs around $5,500, $5,600. Support levels. Near recent pullback points. This forecast is conditional, not guaranteed. No one can predict markets with certainty. It's about probabilities. Let's conclude with a reminder. Gold forecasts are dynamic. They evolve with data. Market participants must stay updated. Tomorrow's trading could bring surprises. It could confirm existing trends, or it could reverse quickly. That's the reality of financial markets. Gold remains one of the most closely watched assets because it reacts to macro forces broadly, from inflation to geopolitics, from central bank decisions to global risk sentiment. For global investors, gold is a key barometer. For U.S. investors, gold interacts with domestic policy expectations. Now over to you, our audience. What do you think tomorrow's gold price will be? Will gold continue higher? Will it consolidate? Or will it pull back? Tell us in the comments and give us your reasoning. Do you think geopolitical risk will keep prices elevated? Or will macro data force a correction? No single forecast is right for everyone, but your perspective matters. Leave your prediction below and explain your reasoning. We'll read and respond. That's how we learn from each other. If you found this forecast useful, hit like, subscribe for market updates, and share with others who follow gold. Markets are dynamic, and staying informed is key. Thank you for watching. Stay disciplined, stay analytical, and stay tuned, because tomorrow's price action could be fascinating. Whether gold rises, or consolidates, or pulls back, there's always something to learn. We'll be back with more updates. Good luck with your trades and your investments. Remember, forecasts are guides, not guarantees. You decide what to do with them. Thank you again for watching. See you in the next video.